Good day, guys. Welcome back. So today we continuing with reading the Candlestick Bible. All right. So we are resuming from page 40, if I'm not mistaken. All right. So the Harami pattern or the inside bar. The Harami pattern, also known as the pregnant in Japanese, is considered as a reversal and continuation pattern, and it consists of two candlesticks. Okay, so it's considered as a reversal and continuation pattern. That's one thing you need to know. The first candle is the large candle. It is called the mother candle, followed by a smaller candle, which is called the baby. For the Harami pattern to be valid, the second candle should close outside the previous one. This candlestick is considered as a bearish reversal signal when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of a downtrend. See the example below. So it'll be looking something like this. It's more like inverse of a bullish engulfing candle. So remember, a bullish candle will be like this. Then there will be a smaller one on this side, price coming down. Then you get a bullish engulfing here, then price goes up. So this is more like a mirror version of this, of the bullish engulfing. Okay, so that's the bullish inside bar. Price will be coming down. Then it shows that's the inside bar there. Okay. Here's the bearish version. As you see, the smaller body is totally covered by previous mother candle. Don't bother yourself with colors. The most important is that the smaller body closes inside of the first big candle. The Harami candle tells us that the market is in an indecision period. In other words, the market is consolidating. So buyers and sellers don't know what to do, and there's no one control the market. When this candle stick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives a good opportunity to join into the trend. And if it is occurred at the top of an uptrend or at the bottom of a downtrend, it is considered as a trend reversal signal. Look at the example below. Okay. So I think there's two examples on the same chart. So price was coming down, inside bar. Price consolidated a bit before they shifted the zone. At the top, we can also call this, I believe there's a setup we read on the pages above, which looks like this, whereby there's one candle big here, one candle big here, then there's a doji in between. Okay, so it's basically a variation of that. Okay, it's more or less the same thing. So from there, you can see price then gave a bearish engulfing, played around the same area before they shifted the zone. Okay. In the chart above, you can see how the trend direction changes after the Harami pattern formation. The first bullish Harami pattern occurred at the bottom of the downtrend. Sellers were pushing the market lower. Suddenly, price starts consolidating, and this indicates that the selling power is no longer in control of the market. The bearish Harami is the opposite of the bullish. This one occurred at the top of an uptrend, indicating that buyer's domination is over and the beginning of a downtrend is possible. When this pattern is created during an uptrend or a downtrend, it indicates a continuation signal with the direction of the market. Okay. We will study in details how to trade this pattern either as a reversal pattern or as a continuation pattern in the next chapters. Tweezer tops, tweezer bottoms. So let me see if I've got a charts nearby. This is what V75. Let's go to the 4 hour. I want to see if we can look at one or two examples. Let's see. Okay, this almost looks like one here on the left. When the market was in sort of a range there. Okay, price came down. This one, not really. These ones, not really. Nothing here, nothing here, nothing here. Okay, there's really nothing on this asset. But anyways, let's go back to the book. I'll try to pinpoint them as we go through the charts in later pages. Okay, tweezer top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezer bottom formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. See the example below. So basically, prices to be coming up. Then okay, bearish, bullish. I think this is for buying. Let me just okay, trees are bottom here. This is for buying. Price will be coming down. Then we get a tweezer bottom, then price goes up. So sometimes in the lessons you hear me referring to these tweezer candles as RR candlesticks. That comes from like BTMM books, because these candles look like a railroad, right? Railroad. So I might refer to them as RR candlesticks. It's basically the same thing. Okay, trees are top. This is for sales. So price basically will be coming up. We get these in price reverses. Okay. These are easier to spot on the charts. If you open your charts, you easily see these. Tweezer top formation consists of two candlesticks. The first one is a bullish candlestick followed by a bearish candlestick. And the tweezer bottom formation consists of two candlesticks as well. The first candle is bearish followed by a bullish. So we can say that the tweezer bottom is the bullish version of the tweezer top, just opposites. The tweezer top occurs during an uptrend when buyers push the price higher. This gave us the impression that market is still going up, but sellers surprised buyers by pushing the market lower and closed down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with other technical tools. The tweezer bottom happens during a downtrend. When sellers push the market lower, we feel that everything is going all right. But the next session price closes above or roughly at the same price with the first bearish candle, which indicates that buyers are coming to reverse the market. If this price action happens near support level, it indicates that a bearish reversal is likely to happen. Okay, here's a clean example. If you open your charts, H1, preferably H1, H4, these patterns, there are plenty of them. Even F15, you can get them depending with your trading style or what type of trader you are. The chart above shows us tweezer bottom that occurs in a downtrend. The bears push the market downward on the first session. However, the second session opened where prices closed on the first session. We went straight up, indicating a reversal buy signal that you can trade if you have other elements that confirm your buying decision. Don't focus on the name of the candlestick. Right? Don't worry about names. Try to understand the psychology behind its formation. This is the most important thing. Because if you understand why it was formed, you understand what happened in the market, and you can easily predict the future movements of price. Candlestick pattern exercise. Now I think you get some information about Japanese candlesticks. You know the anatomy of each candlestick and the psychology behind its formation. Let's take this exercise to test your knowledge and see if you still remember all the candlesticks we talked about. Look at the chart below, try to find the name of each candlestick. So I'm going to give you guys maybe a minute. Just write on a piece of paper. If you're going through this, just write number 1, what candlestick that is, up until number 7. I'll just give you guys a minute to do that before I do it on my end and see if we get it correct. These should be easy. All of them should be easy. Usually the names can be confusing, but as long as you know like what's behind the psychology behind the formation of the candle. So here, this looks like an inside bar candle to buy, right? For me, that one is an inside bar. The next one, it looks like an RR candlestick pattern. This one looks like a bullish engulfing. The next one also looks like a bullish engulfing. And the following one. This one is also a bullish engulfing, if I'm not mistaken, with the doji inside here. Then this one looks like an inside bar for sales right there. So let's just go through them and see. Maybe the names were messed up. If you can easily identify these candlestick patterns and you understand why they are formed, then you are on the right path, right? So, okay, let's just explain them before we go into the information. You see these highs here? Price came and retested there. So there is a psychology behind the formation of these candles to confirm buys. Okay, same thing here, these highs here. Okay, there we go. And this high here and right here. These highs probably, if we have like a moving average, I'm sure this one was on a moving average. But again, there's these highs here where price touches. So you should just know how price is moving. So we agree that this is an uptrend. It's high highs, right? So let me not get much into that because that's actually like lessons now. But anyways, that's the concept behind formation of these candlesticks. If you still struggle to identify these patterns, you have to start learning about them again till you feel like you can master them. So remember, again, practice makes perfect. Practice makes perfect. Let's try to answer the questions concerning the candlestick patterns on the charts above. Bullish harami is the number one inside bar. Bullish tweezers, number two, number three, engulfing bar, number four, engulfing bar, number five, engulfing bar, number seven, harami pattern. So we got them all correct. So you can see, I think there is let me just go through it. Bullish harami, the formation of this candlestick pattern indicates indecision in the market. In other words, the market was consolidating during this session. Bullish tweezers, the market was trading up. Sellers tried to push the market lower, but the reaction of buyers was more powerful. This pattern represents the battle between sellers and buyers to take control of the markets. Number three, bearish engulfing. Sellers were engulfed by buyers. This indicates that buyers were still willing to push the market higher. 4, 5, 6, 7. This pattern shows us 4, 5, 6 engulfing. We all know this one. Harami pattern number 7. This pattern shows that the market enters in a consolidation phase. During this session, so buyers and sellers are in an indecision period, and no one knows who is going to be in control of the market. Let's take another exercise. Look at the chart below. Try to figure out this candlestick pattern. So again, we're going to take a minute. Try to see if you know these candles. If you've got a piece of paper, your notebook, write them down. And let's see if we get them correct. Okay. So I will just try to be fast because of the size of this video. So I just want to try and make them short. So what do we have on number one? Number one, I feel like that's a bullish engulfing. Number one is a bullish engulfing since it's engulfing this candle here. Number two looks like a doji type of candle, pin bar, and a doji. So it's a pin bar and a doji. Number four looks like a bullish engulfing. Okay, so let's quickly scroll down and see what we have there. Okay, number one, bullish engulfing. Number two, hammer or pin bar, which is more or less the same thing. Number three, hammer, which is the large body, and the smaller body, baby harami. So more or less the same thing. So the doji was basically this one. So this is a variation of an inside bar. You see this, calling it a baby harami. So it's a variation of an inside bar, but then it was followed by a doji outside here. Then number 4, bullish engulfing bar. Please, I want you to open your charts and do this homework over and over again. You will see that with screen time and practice, you'll be able to look at your charts and understand that what the candlesticks tell you about the market. Okay, this is something you need to do on a regular, especially if you are not consistent or if you just want to sharpen your skill. Just make sure you put in more screen time and more practice. Look for the candles, back test as much as you can. Don't worry about how to enter and exit the market for the moment. Take your time and try to master the candlestick patterns as discussed in previous chapters. In the next chapters, I'll arm you with techniques that will help you identify the best entry points and exit points based on candlestick patterns in combination with technical analysis. Trust me, these price action strategies will turn you from a beginner trader who struggles to make money in the market into a profitable price action trader. All right, so market structure. This is one of the important aspects of trading, right? Market structure. This is like the backbone of price action. So one of the most important skills that you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You are not going to trade all markets the same way. You need to study how the markets move, how traders behave in the market. The market structure is the study of market behavior. And if you can master this skill when you open your chart, you'll be able to answer these important questions. What the crowds are doing, who is in control of the markets, buyers or sellers, what is the right time or place to enter or exit your market, and when you need to stay away. Through your price action analysis, you will experience three types of markets, which are trending markets, ranging markets, and choppy markets. In this chapter, you will learn how to identify every market and to trade it. So the first thing or the first aspect you're looking at is trending markets. Trending markets are simply characterized by a repeating pattern of higher highs and higher lows in an uptrending market and lower high and lower low in a downtrending market. Okay, see the example below. An example of an uptrend. So you can see this is an example of an uptrend, right? Price simply needs to be creating higher highs and higher lows. I'll be going fast through this. Now, all you need to do is like check your charts, open your chart and see what it's doing. Is it trending up? Is it trending down? Or is it ranging? Okay, so I'll try not to waste time on these illustrations. As you can see in the example above, the market is making a series of higher highs, higher lows, which indicates that the market is uptrending. You don't need indicators to decide if it's bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trend. Another example of a downtrend, as you can see, that's a downtrend, lower highs and lower lows. All right, the example above shows a bearish market. As you can see, there are a series of higher lows and lower lows, which indicate an obvious downtrend. Trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it's doing a series of higher highs and higher lows, it's simply an uptrend market. Conversely, if it is making a series of lower highs and lower lows, it is obviously a downtrend market. According to statistics, trends are estimated to occur 30% of the time. Okay, trending markets only happen 30% of the time. So while they are in motion, you've got to know how to take advantage of them. To determine whether the market is trending or not, you have to use bigger time frames, such as the 4-hour, the daily, and the weekly time frame. Never try to use smaller time frames to determine the market structure. Remember, the higher time frame is good, more weight, it's got more power. Okay, so always make sure when you're drawing your support and resistance or checking your trends, you want to check 4-hour. You want to check the daily and the weekly, mainly, especially for day traders or any other type of trader, really. Then once you have your zones or your market structure drawn, when you come to a smaller time frame, it just becomes easier. You'll just be waiting for your entry. How to trade trending markets. If you can identify a trending market, it will be easy for you to trade it. If it's a bullish market, you will look for a buying opportunity because you have to trade with the trend. And if the market is bearish, you have to look for a selling opportunity. But the question is, what is the right time to enter a trending market? Trending markets are characterized by two important moves. The first move is called the impulsive move, and the second move is called the retracement move. Okay, so before we get to that illustration, let me just show it. So an impulsive move is the bigger move, right, in the direction of the trend. Then price will take a breather and retrace. That's the retracement. Then the impulsive move continues in an uptrend. Then in a downtrend, it's an impulsive move, a retracement, impulsive move, just like that. So when you open your charts, you just need to check for these things. So that's an example. You can see impulsive and retracements. As you can see, the market is making higher highs and higher lows, which indicates a bullish market. If you see this market, you would think of buying, but as you can see, the market is making two different moves. The first move is an impulsive move, and the second one is a pullback or a retracement, which is a corrective move. So these are all the terms used to define that short move or that breather when price takes a breather from a big move. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profits at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. If you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Traders who buy an uptrend market at the beginning of a retracement move, they get caught up by professional traders and they don't understand why the market hit their stop losses before moving in the direction, before moving in the predicted direction. Okay, so this is a downtrend. The illustration above shows a downtrend market. As you can see, the best trading decision is to sell the market at the beginning of an impulsive move. If you try to sell the retracement move, you'll be trapped by professional traders and you'll lose your trade. Now that we know how to identify downtrends and uptrends and how to differentiate between an impulsive move and a retracement move, this is very important for you as a price action trader to know. But the most important question is how to identify the beginning of the impulsive move to enter the market at the right time with professional traders and avoid being trapped in the retracement move. To predict the beginning of the impulsive move in a trending market, you have to master drawing support and resistance levels. What are support and resistance levels and how to draw them on our charts? This is what we'll see in the next chapter. Okay, so before we start on support and resistance levels, I feel like this is an important topic on its own. So it will have, when we resume, I'll resume from page 58. Okay, so what I'll simply do now is I'll go to the charts and we will look at the examples of uptrends and downtrends. Okay, so when you open your chart like this, you want to see where your price is going. So from this basic chart we're opening, you can see price came down, up, down, up, down. Okay, so this is a lower high because it's lower than this high here. So it becomes a lower low. This is a lower low. Sorry, it becomes a lower high. This is a lower low because it's lower than these lows here. And it's also lower than this low here. Then price pushes down. Here's another lower low, which is lower than this one. Lower high. That means we are in a downtrend, right? Then once this lower high is broken, price creates a higher high. Pulls down from these lows, we've got this higher low. Then we've got another higher low here. Then price creates another higher high here. All right, so within this particular section, you can see there's an uptrend going on in there. There's higher highs, higher lows, higher highs, higher lows, as you can see, right? So you can still be able to take trades in there. It's the same thing. This is now an uptrend. On the left way, the downtrend. So you should be able to see what the market is doing and you trade accordingly. As you can see here, this zone, this high was broken, price came here. That's like an entry for trades. Those who are with us on sessions, I think there's a certain group of people, let me just confirm the name. Let's see. Okay, class of 2022 Forex training. Guys, we've been on this topic for quite some time now, whereby we talk about these zones are support and resistance. So you get to understand them on the next few pages, which we are going to read. So for now, don't worry about them since we are only looking for trends. Okay, we're only looking for downtrends. Okay, let me actually go to the weekly or daily rather. See what we have here. Okay, so from round about this area, we had a downtrend, right? You can see higher highs, higher lows until we broke here. So now price looks like it's going up. Okay, so they might want to start forming an uptrend. Those are all the things we look forward to when we are looking at price. So we just simply have to wait and see what the dealer does. Here we've got a downtrend, right? Here, these highs almost look like equal, these highs here. So once you get equal highs, it will get us to another type of market, which is called a ranging market, but we will go through that one on the next couple of pages. So let's just do this here. That's better. Okay. From here, you can see we started having lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. So within this period, we could have been looking for nice sells because we're in a downtrend. You simply have to wait for price to pull back up. But that will only make sense after you understand support and resistance. Then from there, price started pushing up, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, until the last low was broken. That's when the trend changes. But you just need to pay attention that the last lower high is not broken, because if they break it, it usually signals a change of direction. But with the other confluences we will learn, you will be able to decipher what to do, especially in a situation like that. Okay, so those are the examples of uptrends and downtrends. What else do we have here? This looks like ranging. Clean uptrend here. Okay, uptrend, higher highs, higher lows, higher highs, higher lows. Here we sort of break this low, but we fail to continue going down. Then we break this high, so this trend continues, right? Higher high, higher low. Again, here we hit a certain level. We break these lows, and it looks like price wants to go down. But as soon as they continue breaking these highs, you know, uptrend is still valid. Okay, I think that'll be all for today, guys. Thank you so much for your time. I hope this helps. If you have questions pertaining uptrends and downtrends, don't hesitate to hit me in the comments. I can always try to respond and try to assist. So you can just open whatever you trade. Try to check on any time frame, check the trend. Is it an uptrend? Is it a downtrend? So in the next session, we'll resume from page 58, where we'll be talking about support and resistance, which is one of the most important aspects of Forex trading. Once you gather the information from the first few pages and support and resistance, everything starts to make sense. So please go back to the first few pages again, reread, practice. Then as you put in more screen time, you start to understand these candlesticks. Then by the time we continue, you will be up to speed. So again, practice makes perfect. Make sure you enjoy and you practice more. Thank you.